Hi there. Today we're exposing the truth behind the UK mortgage in principle. It feels like a guarantee, but it isn't. If you're buying in 2026, this is crucial.
Hello and welcome. Today we're talking about one of the most important and honestly most misunderstood documents in the whole UK home buying game, the mortgage in principle. Many people think it's their golden ticket, but as we look towards 2026, we have to ask, how reliable is it really?
Just imagine this for a second. You've been scrolling for months, and there it is, the perfect house, the one. But guess what? 5 other people think it's the one too. In a market this competitive, how on earth do you prove to the estate agent that you're the person they should take seriously? How do you get to the very front of that queue? Well, to help you get that edge, all the insights we're sharing today come straight from the specialists at Pro Tax Accountant. These are the people who live and breathe this stuff day in, day out. They know what it really takes to go from house hunter to homeowner. So here's what we're going to cover. We'll start with why it's your key to even start house hunting. We'll break down what an AIP, that's an agreement in principle, actually is. Then, the big one, is it a guarantee? We'll look at why things can go wrong, what to do if they do, and finally, how you can build the strongest possible path to getting that mortgage.
Right, let's dive into that first part. Because honestly, this isn't just a first step. It's the foundation for your entire property search.
Let's be blunt. In today's market, without one of these, you might as well be invisible. An agreement in principle tells sellers and agents you are for real. You're not just a dreamer, you're a credible buyer who's ready to go. Seriously, some agents won't even book you a viewing without one. It's what separates the window shoppers from the real contenders.
So what is this magic piece of paper? You might hear it called a few different things: agreement in principle, decision in principle, AIP, DIP. It all means the same thing.
Okay, the 2 words you need to lock onto here are preliminary and non-binding. This is not a promise. It's an educated guess from the lender. They take a quick glance at the income you've told them about, do a soft credit check, which importantly doesn't harm your credit score, and based on that, they give you a ballpark figure of what they might lend you.
And having one gives you 3 huge advantages right out of the gate. First, it gives you a realistic budget. It stops you falling in love with a place that's just not going to happen. Second, like we said, it proves you're credible. And third, it makes your offer so much stronger. An offer with an AIP attached is always going to the top of the pile.
Now you'll want to hear this part. The moment you get one, a clock starts ticking. These things don't last forever. They're usually only valid for about 30 to 90 days. Why? Well, because your financial situation can change, and so can the lender's rules. If you haven't found a place by the time it expires, you'll have to get it renewed.
Okay, here's where so many people get tripped up. Let's make this simple. You've got your AIP, you're feeling confident, you found the house. Is it a done deal?
And the answer is a big, unequivocal no. I really can't say this enough. It is a heartbreaking moment for so many people when they find this out the hard way. An AIP is absolutely not a guarantee of a mortgage. It is a vital, essential first step, but it is only the first step.
This lays it out perfectly. An AIP is based on what you told them with a light touch check. A formal mortgage offer, on the other hand, that comes way later. That's after they've gone through your bank statements, your pay slips, your P60s with a fine-tooth comb. After they've done a full valuation on the property and, crucially, run a hard credit check that leaves a mark on your file. That is the legally binding promise to lend you the money.
This is a trap that's so easy to fall into, so stay with me. This next point is vital. You get the AIP, your offer is accepted, and then the lender says no. It's soul-crushing, and it happens more than you think. But why?
Well, have a look at this. The reasons are pretty spread out. The single biggest culprit, at 35%, is stuff lurking in your credit history that the soft check didn't pick up. But look at the others. A quarter of the time it's because of income or job issues. And then you have problems with the property itself, and this mysterious thing called the lender's internal scorecard.
Let's break those down. Maybe you completely forgot about that old credit card you have. The hard check will find it. Maybe you missed a single mobile phone payment last month. That's a red flag. Or what about the house itself? If it's built with a timber frame, or it's a concrete prefab, or it's a flat above a kebab shop, lenders get nervous. They see it as a higher risk. And a short lease? If it's under 80 years, for many lenders, that's an automatic no.
Now this is the real kicker, and it catches so many people out. Every lender has its own secret recipe, its own internal checklist. You could have a perfect credit score, a great job, a big deposit, and you still might not tick all their boxes.
Maybe they've just lent too much money in that area this month. You'll never know. It's a completely hidden hurdle that can stop even the best application in its tracks.
So, what happens if you do get that dreaded no? I know it feels like the end of the world, but it absolutely is not the end of the road. Don't panic. There's a clear path forward.
Here's your 4-step recovery plan. 1. Find out the exact reason you were declined. Don't guess. 2. Get your full credit reports and go over them line by line. 3. If you can, look at boosting your deposit. Even a few extra £1,000 can make a huge difference. And 4, and this is probably the most important, talk to an expert mortgage advisor. They know which lenders are right for which circumstances.
And here's a pro tip. This catches a lot of people out. Your first instinct might be to panic and just apply to another bank straight away. Do not do this. Every application leaves a hard search on your credit file, and a load of those in a short time makes you look desperate to lenders. It can actually hurt your score and make it even harder to get approved. Just pause, breathe, and plan your next move.
Okay, let's finish up by looking at how you can make yourself mortgage ready from day one and give yourself the absolute best shot at hearing that yes.
These are the golden rules. Pay every single bill on time. Make sure you're on the electoral roll. It's a massive tick for lenders. Try to keep your credit card balances below 30% of the limit. It shows you're not maxed out. Don't think out any new finance, not a car loan, not even a new phone contract for at least 6 months before you apply. And show that you can save regularly. It proves you're financially stable, which is exactly what they want to see.
And of course, just a quick disclaimer, this is all for general guidance. The financial world is always changing, so while this is accurate for February 2026, you should always get professional advice that's tailored to your own personal situation.
And for that kind of personalized advice, especially if your situation is a bit complicated, we really do recommend getting in touch with the experts at ProTax Accountant. They can help you figure out the best way forward.
We really hope this has helped demystify the agreement in principle. It's a fantastic tool as long as you understand what it is and what it isn't. For more practical financial tips just like this, please do subscribe to the ProTax Accountant channel. Thanks so much for watching.